I'd like to introduce you to today's speaker, Whitney Crockett. She's a CPA. She is a manager at Mason Associates. Whitney has been with us for 9 years. She specializes in auditing the special district and other municipalities. She graduated from Washington State University with a Master of Accounting in 2012. Again, she's a certified public accountant in the state of California. And Whitney has been a frequent speaker in our Maze Life events as well as other events in the Bay Area. With that, please help me welcome Whitney.
Thank you for the wonderful introduction. I am going to share my screen. So let me know if you can see the PowerPoint.
Yes.
Okay. And you don't see my notes, correct?
Yes, correct.
Okay, perfect. Don't want those to be on display there. So welcome to the GASB Updates class. Today we're going to talk about upcoming pronouncements and also with emphasizing GASB 87 leases. So for fiscal year ending June 30, 2021, we have GASB 84 fiduciary activities and GASB 90 majority equity interests, which is an amendment of GASB statements number 14 and number 61, and then implementation guide 2019-1. And then for fiscal year ending June 30, 2022, there is GASB 87 leases, GASB 89 accounting for interest costs incurred before the end of a construction period, and then GASB 92 Omnibus 2020, GASB 93 replacement of interbank offered rates, and GASB 97 certain component unit criteria and accounting and financial reporting for Internal Revenue Code section 457 deferred compensation plans. And some of your agencies might consider implementing GASB 97 in conjunction with GASB 84, especially if implementation would change the presentation of any fiduciary activities. So I'll discuss that in a bit, but just want to point that out. Okay, and then in fiscal year ending June 30, 2023, GASB 91 conduit debt obligations is effective, and GASB 94 public-private and public-public partnerships and availability payment arrangements, and then GASB 96 subscription-based information technology arrangements. So for those of you who have December 31st fiscal year end dates, the implementation years are a little bit different. So for December 31st, 2021, GASB 89 is effective. And then for fiscal year ending December 31st, 2022, GASB 87, 91, 92, 93, and 97 are effective. And then for fiscal year ending December 31st, 2023, GASB 94 and 96 are effective. Okay, so the first one we're going to talk about is effective in fiscal year ending June 30, 2021. And this is GASB 84 fiduciary activities. So under this GASB, there are several different types of fiduciary funds. And they include pension trust funds, investment trust funds, private purpose trust funds, and custodial funds. So there's two criteria that must be met in order for an activity to be considered fiduciary. The first is that the government must control the asset of the fiduciary, and they must have the ability to control providing benefits to the recipients. So as long as those two criteria are met, they must be reported as fiduciary funds. And for those of you that have PARS OPEB plans that were previously reported as an OPEB trust fund, there will be a presentation change for GASB 84, and I'll get more into that in a little bit, but just want to point that out and also highlight the CCMA white paper. There's a link on the slide to the site where it has the white paper, and I definitely suggest you look at that to make sure that you take a look at some of the discussion points in there. And if you are attending the 11 a.m. class, Catherine will be going over this in detail, so stay tuned for that. Okay, so GASB 90, majority equity interests. This is an amendment of statements 14 and 61, and this is effective in fiscal year ending June 30, 2021. So basically, this GASB is modifying previous guidance for reporting a government's majority equity interest in a legally separate organization, and is providing new guidance for reporting a component unit in that the government must have 100% equity interest. So GASB defines an equity interest as a financial interest in a legally separate organization, evidenced by the ownership of shares of the organization's stock or the measurable right to the resources of the organization. So there's two ways to report these types of situations. So a government can own or acquire a majority of the equity interest in a legally separate organization. If a government's holding of that equity interest meets the definition of an investment under Statement 72, then the equity interest should be reported as an investment and measured using the equity method. And then in this case, the legally separate organization should not be reported as a component unit. If it is reported as a component unit, it should also be reported as an asset of the government or fund that holds the equity interest. And it should be measured using the equity method. And also, if it is a blended component unit, any asset and net position associated with the interest should be eliminated during that blending process. So if a government acquires a 100% equity interest in a legally separate organization that's reported as a component unit, the component unit should measure its assets, deferred outflows, liabilities, and deferred inflows at the date in which the government acquires the 100% equity interest. And that consideration should include the net resources exchanged to complete acquisition of 100% equity interest, plus any balances of any equity interest asset, and deferred outflows recognized prior to completion of that acquisition. So from that point on, the flows of the component unit should only include transactions that occurred subsequent to acquisition of the 100% equity interest. Okay, I think it's time for poll number 1.
Stephanie, can you release the poll, please?
Okay, so I'll let everyone answer and I'll continue to the next slide. Okay, then Implementation Guide 2019-1. This is a clarification of previous pronouncements, and it's effective fiscal year ending June 30, 2021. And the majority of the 18 questions and answers in here are OPEB related, but also they discuss derivatives and non-exchange transactions, also an impairment loss, sales and pledges of receivables, fund balance reporting, tax abatement disclosures, and then irrevocable split interest agreements, with the rest being insignificant changes. Oh, wow. Everyone wants to go to Hawaii. Nice. Me too. Okay, so GASB 87 leases. This is the big one that will be effective in fiscal year ending June 30, 2022. So, just to give you a bit of history on this, under previous GASB guidance, GASB Statement 15, leases were classified as either capital or operating, depending on whether the lease met any of four tests. And in many cases, the previous guidance resulted in reporting lease transactions differently than similar non lease financing transactions. So, this statement is bringing GASB in line with FASB for reporting leases. And it's also including all lease transactions. So, both operating and capital leases would be considered under this GASB. And it further defines a lease as a contract that conveys the right to use the non-financial asset for a period of time in an exchange or exchange-like transaction. So the overall determination will depend on the lease contract and whether it whether it conveys the control of the right to use the underlying asset, such as the right to obtain the present service capacity for use of the underlying asset. And that would be specified in that lease contract, and the right to determine the nature and manner of use of the underlying asset. So the big thing to remember is that the distinction between capital and operating is eliminated, and it's more focused on the long-term versus short-term leases, with short-term leases being more those that are 12 months or less, including any options to extend the lease. So the other big part is that the lease must be non-cancelable. So that's a really key piece to remember when you're assessing your lease agreements. So some questions that have come up that we've seen are if, number one, copy machines would apply. So technically, copy machines do apply, but number one, materiality should be taken into consideration. So depending on your lease threshold that you establish, it may or may not be material. And also, you wouldn't include the supplies component like toner and paper as part of that overall dollar amount in that determination. So that's another key piece. And then another type of lease that's been brought up are those for building leases. So building leases would apply under this GASB, but they wouldn't include the maintenance piece of them. So a lot of those building leases have maintenance associated with them, and that shouldn't be included in that determination. And then GASB does list some specific exclusions. So exclusions include leases of intangible assets, biological assets, inventory, and contracts under the definition of a service concession arrangement, and then supply contracts like agreements to purchase power. Okay, so some other considerations that GASB discusses under 87 is that contracts with multiple components and contract combinations should be treated as separate leases. So a good example of that would be a lease agreement that has the option to lease multiple pieces of equipment or vehicles. So if that is the case, each one should be treated separately under GASB 87. And they also discuss treating lease modifications and terminations. So what needs to happen when those come up. And then they also state that subleases and leaseback transactions must be treated as separate transactions. So for those, you would have number one, a sale transaction, and number two, a lease transaction. Okay, so now let's talk about the lease term. So the lease term is really important with this GASB, and that is going to be the non-cancelable period plus periods covered by the lessee option to extend the lease, the lessee option to terminate the lease, and then also on the lessor side, the lesser option to extend and the lesser option to terminate. So again, the lease term is the period in which a lessee has a non-cancelable right to use the underlying asset. And that's referred to as the non-cancelable period. And that it must be reasonably certain that the event will occur. So at the commencement of the lease term, the lessee and the lessor should assess all factors relevant to the likelihood that the lessee or lessor will extend or exercise those options, as I just mentioned. So some factors to think about with determining whether an event will be reasonably certain include significant economic incentives, for example, favorable contractual terms, also a significant economic disincentive, so like negotiation costs, relocation costs, or cost to return that asset, and also the history of exercising options to extend or terminate. Is there a history there that can be used in that determination? And also the extent to which the asset underlying the lease is essential to the provision of government services. Okay, so when does one reassess the lease term? So the lease term should be reassessed if, number one, there was an option elected that was not previously reasonably certain. So something changed where an option was elected and it came to as a shock. And then also, if an option that wasn't elected, an option wasn't elected that was previously reasonably certain, then the lease term should be reassessed. And then if there is an event that requires extension or termination of the lease, then that lease term should be reassessed. Okay, so periods for which both the lessee and the lessor have an option to terminate the lease without permission from the other party are considered to be cancelable periods and are excluded from the lease term. For example, a rolling month-to-month lease or a lease that continues into a holdover period until a new lease contract is signed would not be enforceable if both the lessee and the lessor have an option to terminate and therefore either could cancel the lease at any time. And then it also does not include a fiscal funding or cancellation clause that allows a governmental lessee to cancel a lease, typically on an annual basis, if the government does not appropriate funds for the lease payments. So this type of clause would affect the lease term, or should affect it, if it's reasonably certain that the clause will be exercised. Okay, so if a lease is considered to be a short-term lease, then it does not need to be recorded on the balance sheet under GASB 87. Those are leases that are have a total possible term of 12 months or less, including options to extend, regardless of probability of being exercised. So for short-term leases, those should be accounted for as operating leases. Okay, so let's talk about the accounting and reporting on the lessee side. So at commencement of the lease, a lease liability will be recognized and an intangible lease asset will also be recorded. And that's going to be a capital asset referred to as the lease asset. So first, let's talk about the lease liability. So that's going to be measured at the present value of the payments expected to be made during the lease term, less any lease incentives. And those lease incentives are payments made to or on behalf of the lessee for which the lessee has a right of offset with its obligation or any other concessions. So it's kind of like a bonus to the lessee. And the lease asset is going to be measured at, number one, the lease liability, but also any lease payments that are made to the lessor at or before commencement of the lease term would be included as an asset. And then any initial direct costs that are ancillary charges necessary to place the lease asset into service would be included. And as payments on the lease are being made, the lease liability will be reduced and an expense will be recognized. And then the lease asset's going to be amortized over the shorter of 1, the lease term, and 2, the useful life of the underlying asset. So the amortization is going to be reported as an expense, which for purposes of reporting may be combined with depreciation expense related to other capital assets. So something to keep in mind. Okay, so provisions that allow for termination of a lease due to 1, purchase of the underlying asset, or number 2, payments of all sums due, or default on payments are not considered termination options under this GASB. Okay, so we're ready for poll 2. Dun, 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 dun. Okay, I'll let people answer and move on. Okay, so for the disclosures, the lessee disclosures are going to include a general description of leasing arrangements. So that'll include the basis, terms, and conditions on which variable payments not included in the measurement of the lease liability are determined, and the existence, terms, and conditions of residual value guarantees provided by the lessee not included in the measurement of the lease liability. Also, the total amount of lease assets and related accumulated amortization should be disclosed. And this is going to be separately disclosed from other capital assets. Good job. 12 months or less. Yep, that's a short-term lease. Okay. So other disclosures for the lessee is amount of lease assets by major classes of underlying assets. And those should be disclosed separately from other capital assets, like I mentioned. And then the amount of outflows of resources recognized in the fiscal year for variable payments not previously included in the measurement of the lease liability. Okay, and then principal and interest requirements to maturity should be disclosed, similar to that of debt maturity tables or schedules. So each of the 5 subsequent fiscal years should be included in there, and then 5-year increments thereafter. So very similar. Okay, then also in the disclosures, commitments under leases before the commencement of the lease term should be disclosed if there's any of those types of commitments, and components of any loss associated with any impairments recognized on the lease asset during the period. So if there is any sort of impairment loss, then it needs to be disclosed. And then there's additional disclosure requirements for sublease transactions, sales leaseback transactions, and leaseback transactions. Okay, so let's talk about the lessor side. So on the lessor side, at commencement of the lease, there's going to be a lease receivable and then a deferred inflow of resources. And the underlying asset, the asset underlying the lease should not be retired. It should continue to be depreciated as normal. So the lease receivable slash asset is going to be equal to the present value of lease payments expected to be received during the lease term, including any fixed payments, variable payments, any lease incentives, and residual value guarantee payments that are fixed in substance as applicable. So it's not always going to be the case that all those are included. And then the discount rate that should be used would be that the rate that the lessor charges the lessee. And if that rate is not determinable, the GASB implementation guide does provide guidance on determining that discount rate. And then as payments are being received on the lease, interest revenue on the lease receivable will be recognized. And then there's going to be revenue from deferred inflows of resources over the term of the lease. And the asset will continue to be depreciated. So for the amortization piece, the lease asset should be amortized in a systematic and rational manner over the shorter of the lease term or the useful life of the underlying asset, similar to the lessee treatment of amortization. And then that amortization should be reported as an outflow of resources. So it will be part of the income statement. So disclosures on the lessor side, one, there's going to be general description of the leasing arrangements, and that will include the basis, terms, and conditions on which variable payments not included in the measurement of the lease receivable are determined. And then the amount of inflows of resources, so lease interest and any other related inflows, recognized in the fiscal year from leases, if not displayed on the face of the financial statements. Also, the amount of inflows of resources recognized in the fiscal year for variable payments that were not previously included in the measurement of the receivable, including those residual value guarantees and termination penalties. And then also the existence, terms, and conditions of options by the lessee to terminate the lease or abate, so stop payments, if the lessor government has issued debt for which the principal and interest payments are secured by the lease payments. So there's also some additional disclosures, and these are going to be if they are applicable. So there's leases of assets that are investments, certain regulated assets, sublease transactions, and sale leaseback transactions, and finally leaseback transactions. So GASB does discuss disclosure requirements for those types of situations. Okay, so let's talk a bit about regulated leases. So some of you may have these types of leases, and these are certain leases subject to external laws, regulations, or legal rulings. So GASB calls these regulated leases, and certain regulated leases are not subject to GASB 87. So one example is those types of leases between the U.S. Department of Transportation and the Federal Aviation Administration, that they regulate aviation leases between airports and air carriers. So some of those may be considered regulated leases under this GASB. And really, although the lease liability doesn't need to be recorded or lease asset, there are disclosure requirements for regulated leases, no matter what, if those exist. And the disclosure should include just a general description of the regulated lease, and also the extent to which capital assets are subject to preferential or exclusive use by counterparties under agreements, by major class of assets, and by major counterparty. And then also the total amount of inflow of resources recognized in the fiscal year. Then the expected future minimum payments, there should be a schedule in the disclosure for what payments will be received in the future. and the amount of inflows recognized in the fiscal year for variable payments not included in the expected future minimum payments. And then the existence, terms, and conditions of options by the lessee to terminate the lease or stop abate lease payments if the lessor government has issued debt for which the principal and interest payments are secured by the lease payments. So really the disclosure piece is similar to that of, leases that fall under GASB 87. It's just that there's no lease asset to be recorded or lease liability. Okay, so let me make sure I didn't miss, the polls under this. So how to prepare for GASB 87. So one thing is keep in mind that a restatement to record the balances at the beginning of the fiscal year will have to be done for this GASB. So it's a good time to really get started on taking an inventory of these lease agreements and start developing a process. A good suggestion that we've heard is to establish a materiality level or threshold for which leases will be recorded. So definitely start having those discussions. And also, ask yourself things like which leases are going to fall under the statement. Also, which ones will still be in place during implementation year. And consider terms and possible modifications along the way. Is there any clarification needed? If there's any agreements that have terms that are kind of gray, it might be a good time to start looking at those and asking questions, getting clarification, and also considering if there's going to be any impact on debt covenants or fund balance policies with the addition of the liabilities on the balance sheet. And also, developing your system of internal controls is important, especially if you're an agency who has a decentralized contracting department. You may not know right away if a lease, a lease agreement is signed or if there's like a new lease. So really keeping that communication channel open if you have a decentralized department is good so that you can ensure to incorporate all the leases. And also preparing your process will prepare yourself for new agreements you'll encounter during implementation year. And I know that some people have thought about using technology solutions. So there's several places who are offering technology solutions for recording leases and tracking them. And so I think it's really going to be a personal decision, cost benefit analysis, depending on how much lease activity you have, if it's worth it or not. But just always keep in mind that implementation does take longer than you think it will. Okay, so we have another poll. Okay, so for this, I'm going to talk about a couple, I guess we have time. So I'm going to go through a couple of examples. And since we're not in person, I'm not going to have people volunteer to go over answers. I'm just going to kind of talk about the example and if it applies under GASB 87 and why. And then also talk about what things should be included in the calculation of the lease liability. So for this example, this is the first one. I'm just going to talk about the assumptions. So let's assume that the lease contract is for a building and the lease commences July 1st, 2020. There's an 84-month non-cancelable term. There is an option in the contract to extend the lease for an additional 24 months. And the base monthly payment is $1 with a 0% interest rate. Woohoo! And then the market rent is $450 per month. So I'll give you a second to just take that all in, even though you probably have the answer if you have the slides, but don't peek. And yes, the answer to the true or false is true. Certain regulated leases are excluded from GASB 87. Yep, true. Okay, So let's talk about this example and ask ourselves if this lease would apply under Statement 87. So because the base monthly payment is $1, it wouldn't fall under that requirement for there to be an exchange or an exchange-like transaction. And therefore, this lease would not be subject to the provisions of Statement 87. That $1 right to use the building doesn't meet that description because the value received is not received and given is not equal. So especially considering that the market rent for a similar building is $450 per month, the $1 is nowhere near that. So it would be excluded. Okay, so example number 2. So this one is, again, assuming that the lease contract is for a building. The lease commences July 1st, 2020. There's a 60-month non-cancelable term with another option to extend the lease an additional 12 months. The monthly payment is $2,500, and the first month is free, so there's a little bonus in there. There is an early cancellation penalty of $2,500, and the lessee must pay the cost of repair and maintenance, which comes out to be about $2,000 per year. And the borrowing rate is 3.5%, the interest rate. So let's talk about if this lease would apply under Statement 87. So yes, because especially considering, unlike the previous example, that the monthly payment, there's an exchange transaction. So the monthly payment is, value received and given is somewhat equal. So it would apply. And if we're looking to find the lease term, so if we're looking at all these assumptions, it says there's a 60-month non-cancelable term. So would we include the option to extend for the additional 12 months? Well, it doesn't really clarify if it's reasonably certain that they're going to exercise that additional 12 months. So because of that, the lease term should just be the 60 months. And then would the lessor incentive be included? Yes, the lessor incentive should be included. That's the bonus. First month is free. And any cancellation penalty would not be included, only because it doesn't really say if it's reasonably certain that they'll exercise that early cancellation. So it shouldn't be included in that the value determination or measurement. So, and then repairs and maintenance would not be included because the service components are excluded. So that would be just something that's not included in the measurement. So looking at the measurement of the liability, you would have the base payment. So that's going to be discounted, right? So you'll have the $2,500 per month at 60 months. So multiply it, discounted at 3.5%. So that comes out to be about $137,826. There's no excess use charges, so that's not applicable in the measurement. And again, repairs and maintenance would not be included. And same with the cancellation penalties, only because it's not reasonably certain that that will happen. And then you would take out the lessor incentive. So the first month is free, so $2,500 will not be paid, and therefore that should be taken out. So that would be an initial value of lease liability of $135,326. And then that intangible lease asset is going to be equal to the same as the lease liability. There's no delivery and installation costs mentioned, and so that's not going to be a part of the measurement. But you can see how the measurement is going to be somewhat complicated for some. So this is a good example to keep in mind when you're thinking about the implications of this. Okay, so GASB 89, accounting for interest costs incurred before the end of a construction period. This GASB is effective in fiscal year ending June 30, 2022. So under current governmental accounting standards, some governments with a business type activity or enterprise fund are capitalizing interest costs incurred before the end of a construction period as part of the related capital asset. So with the application of the statement, organizations and funds will now expense this type of interest costs as it is incurred. So there will not be any more interest cost capitalization. It was optional in the past, it was not a requirement. So if you are still capitalizing interest, this GASB statement says to stop doing so and to not do it going forward. And there's no need to restate current balance or existing balances. Just stop capitalizing and then move on. So there is one exception to the standard for business type activities that have regulated operations, such as those subject to the MUD Act. Basically, GASB says that the capitalization of qualifying interest costs as a regulatory asset should remain applicable. So that's pretty much the gist of it. I mean, GASB says that, interest costs are more of an expense and more of a financing activity as opposed to a capital related activity. So they should be, expensed as incurred. You just see, sorry. Okay. So GASB 92, this is Omnibus 2020, and it is effective in fiscal year ending June 30, 2022. And it's a hodgepodge of clarifications to previous pronouncements, including GASB 87, leases, reporting of intra-entity transfers of assets between a primary government employer and a component unit, reporting assets accumulated for post-employment benefits, the applicability of certain requirements of GASB 84 to post-employment benefit arrangements, reporting of recoverable funds from reinsurers or excess insurers, and reference to non-recurring fair value measurements in derivative instruments. Okay, GASB Statement 93, this is replacement of interbank offered rates. And this is effective for fiscal years ending June 30, 2022. And some governments have entered into agreements in which variable payments are made or received depending on an interbank offered rate. Most notably used is the London interbank offered rate, also known as LIBOR. And LIBOR is expected to cease to exist in its current form at the end of calendar year 2021, which is prompting governments to amend or replace financial instruments for the purpose of replacing LIBOR with other reference rates. And that's by either changing the reference rate or adding or changing fallback provisions related to that rate. So taking Statement 53, accounting and financial reporting for derivative instruments, as amended, requires this statement requires a government to terminate hedge accounting when it renegotiates or amends a critical term of a hedging derivative instrument. And taking that in conjunction with Statement 87 leases, which says that the replacement of a rate on which variable payments depend on would require government to apply the provisions for lease modifications, including complete remeasurement of the lease liability or lease receivable. So taking those into context, the objective of this statement is to address those and other accounting and financial reporting implications that result from replacing an interbank offered rate. So there is a GFOA member alert on what state and local governments should be discussing with their financing teams. And the link is on the slide. So for those of you who think that this GASB would apply to you, we definitely recommend that you look into that. So yeah, that's pretty much it. Okay, so GASB 97, certain component unit criteria, and accounting and financial reporting for Internal Revenue Code Section 457, deferred compensation plans. This GASB is effective in fiscal year ending June 30, 2022, except for the first two pieces, which are effective immediately. So the first one that's effective immediately is that about the absence of a governing board. So in certain instances, a legally separate organization does not have a governing board. So GASB says that for purposes of determining whether a primary government is financially accountable for a potential component unit, if the primary government performs the duties that a governing board typically would perform, the absence of a governing board should be treated the same as the appointment of a voting majority of a governing board. Okay. And then the financial burden criterion in paragraph 7 of Statement 84 has been amended in this GASB by saying that it's only applicable to defined benefit pension plans and defined benefit OPEB plans that are administered through trusts that meet the criteria under Statement 67 and Statement 74. So the biggest change for those of you in California is that PAR's OPEB trusts should no longer be reported as an OPEB trust fund in the financial statements. And the reporting change will be similar to that of CERBT reporting. So it just won't be a standalone presented fund. So keeping that in mind, GASB 97, some of your agencies should consider early implementing in conjunction with GASB 84 in fiscal year 2021, especially if the implementation would change the presentation of any fiduciary activities under Statement 84. So those are the pieces that are effective immediately. The other part of this GASB has to do with Section 457, deferred compensation plans. And basically, GASB says that those should be either classified as a pension plan or an other employee benefit plan as follows. So if a Section 457 plan meets the definition of a pension plan under GASB 67, 68, and 73, it should be reported and accounted for as a pension plan. But if the Section 457 plan does not meet that definition of a pension plan, it should be reported and accounted for as some other employee benefit plan. And the last piece of 97 is kind of amending Statement 84 in a way, in that it should be applied to determine whether an arrangement organized under Section 457 should be reported as a fiduciary activity in a government's fiduciary fund financial statements. Okay, so GASB 91 is conduit debt obligations. This is effective in fiscal year ending June 30, 2023. So the objective is to provide a single method of reporting conduit debt obligations. And there's 5 characteristics that must be met in order for a conduit debt to apply. And there's the first, which is there are at least 3 parties involved. So number 1, an issuer. Number 2, a third party obligor. And number 3, a debt holder or debt trustee. So the other thing is that the issuer and the third party obligor must not be within the same reporting entity, financial reporting entity. The debt obligation must not be a parity bond of the issuer, nor can it be cross-collateralized with other debt of the issuer. Also, the third party obligor must be ultimately receive the proceeds from the debt issuance. And the third party obligor must be primarily obligated for the payment of all amounts associated with the debt obligation. So they must be making those debt service payments. So this is really a note disclosure GASB. So the disclosures should include, number one, a general description of the conduit debt obligation, including any limited commitments, any voluntary commitments, any additional commitments, and then also the aggregate outstanding amount of all such obligations at the end of the reporting period. And also, just want to point out that if the issuer has recognized a liability, there are additional disclosures which are somewhat similar to those for other types of debt that should be included. Okay, I think we're ready for another polling question, right? Okay, I'll let you guys answer that. Okay, GASB 94, public-private and public-public partnerships and availability payment arrangements. This GASB is effective in fiscal year ending June 30, 2023. And it's really addressing a gap in GAAP. So what they found when they were looking at service concession arrangements under Statement 60, and then also leases under GASB 87, is that there were certain arrangements that did not fall under either. So the purpose of this GASB is to provide guidance on the treatment for situations that fall into this other category. So this GASB is going to supersede Statement 60, accounting and financial reporting for service concession arrangements. And there are two different types of arrangements. So the first is a public-private and a public-public partnership, also known as a triple P. So this is an arrangement in which the government or a government contracts with an operator to provide a public service by conveying control of the right to operate or use a non-financial asset, such as infrastructure or an other capital asset, for a period of time in an exchange or an exchange-like transaction. So what I'll get into in a minute is how certain service concession arrangements are also a triple P arrangement. So an availability payment arrangement is an arrangement in which a government compensates an operator for services that may include designing, constructing, financing, or operating an underlying non-financial asset for a period of time in an exchange or exchange-like transaction. And I'm sorry, Stephanie, can you share the polling results again? I think I clicked out of them. Okay, so it looks like 18% of you are from special districts, 7% from counties, 63% from cities representing, and then 12% from other. All right. Okay, so let's talk about the characteristics of a triple P. So some triple Ps meet the definition of a service concession arrangement. And the board defines a triple P in which, number one, the operator collects and is compensated by fees from third parties. Also, the transferor determines or has the ability to modify or approve which services to provide, to whom to provide the services, as well as the prices or rates to be charged. Then the third characteristic is that the transferor is entitled to significant residual interest of the underlying asset at the end of the arrangement. So the key here is that the transferor has the ability to make the decisions, not the operator. And that's where the gray area has come up with determination of these arrangements, service concession arrangements under Statement 60. Oops. Okay. Availability payment arrangements. So the characteristics for those, that's an arrangement that where government compensates an operator for services of a non-financial asset in an exchange or an exchange-like transaction. And there's going to be services related to design, construction, financing, or maintaining, operating an underlying non-financial asset for a period of time. Well, I already said this, but in an exchange or an exchange-like transaction. That's the key. So APA is related to providing services for the operation or maintenance should be reported. Those transactions should be reported as an outflow of resources, so an expense by the government. So in an APA, I think the big takeaway is that an availability payment arrangement, a government procures a capital asset or service rather than receiving compensation to allow another entity to provide public services. Okay, GASB 96, subscription-based information technology arrangements. This one is effective in fiscal year ending June 30, 2023. And this statement, number one, defines an SBITA. It also establishes that an SBITA results in a right to use subscription asset, which is an intangible asset, and also a corresponding subscription liability. It also provides the capitalization criteria for outlays other than subscription payments, including implementation costs of an SBITA and note disclosures regarding an SBITA. So there are multiple types of arrangements available under this GASB, and those include software as a service, SaaS, infrastructure as a service, and platform as a service. So an SBITA formal definition is that it's a contract that conveys control of the right to use another party's information technology software alone or in combination with tangible capital assets as specified in the contract for a period of time in an exchange or an exchange-like transaction. So in simple terms, the types of situations that this GASB applies to are cloud computing and then information technology arrangements or cloud software. So if you have subscriptions to those types of arrangements or cloud software, this GASB will most likely apply to you. And I think this is becoming more and more common for those that are moving to cloud-based software and otherwise. You know, we've seen a lot of system conversions over the past decade or so, with clients moving from older systems to newer and more robust systems. And a lot of that upgrading has come with the use of cloud-based software and subscriptions to that type of software. Okay, so under the statement, a right to use subscription asset will be recognized and a corresponding subscription liability. So that will be recorded at the commencement of the subscription term, which is the date in which the subscription asset is placed into service. So let's talk about the subscription liability piece first. The liability will be recorded at or measured at the present value of subscription payments expected to be made during the subscription term. And then future subscription payments should be discounted using the interest rate that the vendor, so the vendor that's being used, charges the local government. And sometimes that rate could be implicit. So in lieu of that, the government's incremental borrowing rate can be used if the interest rate is not readily determinable. And then going forward, a government should recognize amortization of the discount on that liability as an outflow of resources, so through an expense in subsequent financial reporting periods. So in terms of the asset part, so the subscription asset is going to include, number one, the initial subscription liability amount. And then it's also going to include payments made to the vendor the SBITA vendor before commencement of the subscription term. So if there were any made, before the subscription actually started. And 3, capitalizable implementation costs, less any incentives received from the SBITA vendor at or before the commencement of the subscription term. And then again, recognizing the amortization of the intangible subscription asset over that subscription term. And that's pretty much it. And I want to see if there's any questions.
Hi, Amy. Whitney. Sorry.
Wow.
You are in my top 5 of favorite people. See, I just blurted out the other 2 first. So
it's fine. I'm used to it.
Okay, so we have a lot of questions. So most of them has to do with the lease GASB. So I'm going to ask the one that is not first, and then I'll ask the other ones. Okay, so we have a question.
Is Amy here too?
I think Amy has stepped out a little bit.
Oh, that's fine. Yeah, she said she. Yeah. Okay.
Yeah, she had yes. Okay, so this is the one that I wanted to ask. Is somebody says for GASB 96, do licenses to use the software fall into this GASB statement?
I don't see that question. Can you repeat that? I'm sorry.
Oh, it's in the chat.
Yeah, I don't see it. So,
do licenses to use the software fall into this GASB 96?
Do licenses to use the software?
Sorry, I'm not available, but I think they do. If there's that right to use, then it does fall into that. If it's on the cloud, it just depends on how the arrangement is documented.
Yeah, I think there's a couple things that come into play there. It's really going to depend on the subscription and what's being used.
Okay. Then there's another question for 96. Will we need to restate prior years if subscription in play? Oh, okay. If they have subscription in place, do they need to restate prior years when they implement GASB 96?
Yes.
Okay.
So at the beginning of the fiscal year would be, the restatement of the year that it's being implemented.
Okay, so then this has to do with the 457 plans. Do we need to report 457 plans as fiduciary of the county? Yeah. Oh, if the county does not match contributions?
I don't know. We might have to get, Amy, do you know?
We'll have to it depends on how the arrangement falls. It just depends on if it is considered, because you have to walk down the path of determining how it falls into the umbrella of fiduciary. And the 457 plans, what I've heard is that, and I don't, this is we have our usual disclaimer at the beginning, this is our opinion and not everything. You have to look at your own facts and circumstances. But for 457 plans, most are probably not going to be reported in a fiduciary fund. But again, you might have a strange arrangement that does pull them in. If they walk and talk like a pension, then they do. So it just depends, because the matching the contributions isn't necessarily, but if you're actually making contributions, or if it falls into that umbrella of functioning as a pension, then it could. But sometimes I believe some of the assumptions are that most 457s would fall under the umbrella of defined contribution, but again, it just depends on how the actual arrangement is.
Okay. So we'll get, I think that's really the thing is how it's.
Okay. So
arranged.
we have about 8 questions that relate to GASB 87. We may not be able to get through all of them in the next 5 minutes. So if we don't get to your questions, we will get back to you after the class. So the first question has to do with cost allocation plan. This person says that we are hearing now that the building leases will have an impact on cost allocation plan. Is that true?
So there is a possibility if the leases are recorded at the fund level. So I would think that would be more of the full accrual funds, your enterprise, potentially internal services. I wouldn't think now, and of course, never say never, but I wouldn't think it would affect the governmental funds, because of the governmental fund side, most of this activity, the lease activity, would be recorded only in the government-wide financial statements, so it wouldn't necessarily affect your cost allocation. But again, at the enterprise fund level, it could.
Okay. Second question is, would apartment type rental units be considered under GASB 87?
I think it's really going to depend on the lease contract. So it has to meet those requirements under 87, like it must be non-cancelable. It has to be long-term, more than 12 months. And there has to be consideration, there has to be an exchange-like transaction. So I think you'd have to walk the path of the requirements there to make sure, but it technically could.
Okay. Sorry, I'm rushing through this.
No, that's fine.
The next one has to do with what is a non-cancelable lease. If a lease agreement has no cancellation language and there is no specific penalty for default other than losing use of the facility, is this considered a non-cancelable lease?
This one stumped me. I don't know. I know, Whitney, you didn't get the benefit of looking at the questions before we got to the end of the class. This one has stumped me a little bit. It's almost as if because if you think about it, the lease term is the non-cancelable period. So in this case, the non-cancelable period, if there's no set time frame, it might be month by month to month. So if it's considered a month to month, then that would be the extent of your non-cancelable period. So then it doesn't qualify. It's not considered a long-term lease. It would be a short-term lease. So it just depends on if there is, because you did say no cancellation language, but is there a term? Is it a 5-year lease, or is it a 1-year lease, or is it month to month? So that might be again where we need to see a little more facts into the arrangement of the agreement.
Okay, so how do you determine the lease term if the agreement is 5 years with renewal of an additional 5 years?
So it depends on the likelihood of the extension of that option. So you definitely, if the first 5 years is non-cancelable, definitely a 5-year lease. And then for the second 5 years, what is the likelihood that you'll extend that option?
Okay. And then there is a request just for fellow attendees that if anyone has already implemented this GASB, if they would like to share their footnotes, that would be greatly appreciated. You can put your information on the chat or just let us know and we can let our attendees know. The next question is, when we talk about materiality threshold, would that be based on the present value of the lease? Yes.
It would be the amount that you're going to be recording.
Okay. How do you determine the interest rate?
Well, it's either going to be, it's part of the lease contract, or it's going to be the incremental borrowing rate that normally the government has. So there's guidance in the implementation guide on determining that borrowing rate. It's really going to depend. Yes.
If it's not an explicit rate in the agreement, then as what you mentioned, is that incremental borrowing rate that you would, if you were to go out and obtain a similar loan.
Okay, and then if developer is paying or reimbursing payments for leases of buildings, will this fall under GASB 87?
Can you say it one more time?
I'm not sure.
If developer is paying or reimbursing payments of lease of building, would this fall under GASB 87?
Oh, so I have to assume you have two separate arrangements. One is you have a lease, and then the developer is reimbursing the entity for those lease payments. It might be one of those where you'd have to identify this specific situation to see what the agreements, because if it's two separate agreements, you would account for them separately. If they're connected, then you'd have to look into it a little bit further.
Okay, so I just want to thank you all because we actually run out of time and we need to, we have a 15-minute break before the next section. So thank you all for attending, and thank you, Whitney and Amy. So we'll see you at 10 o'clock. All right. Thank you.
All right.
Thank you.
Thanks.
Thanks.
Bye.
Bye.